Welcome back to Economic Insights. I'm Alex, and with me as always is Selim, our resident market veteran and show producer. Selim, I have to ask, what just happened? Markets started the week throwing confetti and ended it in panic mode.
Alex, it's been quite the emotional roller coaster. We had the government shutdown ending after 43 days, which should have been cause for celebration. Instead, by Friday, traders were looking like they'd just opened their credit card bills after the holidays. The Fed speakers made sure of that.
Walk us through how this week unfolded. Monday looked pretty good, didn't it?
Monday was euphoric. The Senate passed the stopgap funding bill, and markets went into full rally mode. The S&P 500 jumped 1.54%, best day in 4 weeks. Europe was even more enthusiastic with the stock 600 up 1.42%, its strongest showing since May. Tech stocks were the darlings, Nasdaq flying high, the Magnificent Seven posting huge gains. High yield spreads tightened. Gold had its best day since May. Everyone was in a good mood.
Sounds perfect. So when did the wheels come off?
Well, that's where it gets interesting. Even on Monday, beneath the surface, there were warning signs. Fed speakers like Collins and Bostic started hinting they weren't keen on cutting rates in December. Treasury yields ticked higher. But nobody wanted to listen. The party was too good. Then midweek, Nvidia got whacked when SoftBank announced they'd dumped their entire stake. The ADP report showed the US actually lost jobs over a 4-week period. Suddenly, people started asking uncomfortable questions.
And I noticed Europe kept rallying even while the US started struggling.
That was the bizarre part of the week. While US markets wobbled, Europe was setting records. The StoxX 600 hit an all-time high. Italy's market surpassed its 2007 peak. This is despite UK unemployment coming in higher than expected and German inflation data showing sticky services prices. Europe was basically saying, your problems aren't our problems. That lasted about 2 days before reality caught up.
Then Thursday happened?
Thursday was brutal. The S&P 500's worst day in over a month. Nasdaq got crushed. Magnificent Seven stocks led the decline. Nvidia, Tesla, Meta, all down sharply. The VIX jumped to 20. By the close, the probability of a December Fed rate cut had collapsed to 49%, down from 74% the previous week. That's an extraordinary repricing in just 5 days. By Friday, Bitcoin was below $95,000. Money rotated hard into defensive sectors like healthcare and consumer staples. Classic risk-off behavior.
What spooked everyone so badly?
Two things converged. First, more Fed officials came out expressing skepticism about December cuts. All 4 voting regional presidents are now on the hawkish side. Second, people started worrying about AI valuations again. When you combine doubts about rate cuts with questions about whether tech stocks are overvalued, you get the kind of sell-off we saw. The market basically said, if the Fed's not cutting and tech might be expensive, where's the upside?
Let's focus on the Fed because they seem to be running the show right now. Why are they so resistant to cutting rates?
Here's the thing. Financial conditions have eased dramatically over the past 6 months, despite the Fed not cutting much. It's historically large easing, comparable to what you see after recessions. Add to that the front-loaded fiscal stimulus and retroactive tax refunds, likely coming in early 2026, and the Fed's looking around thinking, the economy's getting all this stimulus already. Why would we add more by cutting rates?
But we're still missing a ton of economic data because of the shutdown.
And that's becoming its own problem. We might get employment data next Thursday, but it will be partial at best, probably just payrolls, no unemployment rate. They'll likely skip October CPI entirely. The Fed might not have October or November data before their December 10th meeting. Powell has hinted that without data, they hold. So, ironically, the shutdown ending might actually ensure no rate cut, because we won't have enough information in time.
That's darkly funny. What's the market pricing in now?
Less than 25 basis points of easing by January. Some analysts still expect 50 basis points. That 25 basis point gap tells you everything about the uncertainty. Markets are essentially flipping a coin on December, 49% chance of a cut. A few Fed speakers like Moran still argue for a half-point cut, but you know what he is,
A dove?
if you say so.
Let's talk about Europe since they seem to be having a better week than the US.
Europe's in an odd position. Growth expectations are modest, 1.4% for 2025, but activity has been trending positively. Germany, of all places, is expected to see the sharpest acceleration. The fiscal stimulus might actually be finally starting to have an impact. The ECB is completely comfortable staying on hold. Markets are only pricing in 7 basis points of cuts by mid 2026. The ECB is basically saying, we're fine here, no need to move.
Meanwhile, the UK's data was weak, but markets rallied on it.
Classic bad news is good news scenario. Unemployment rose to 5.0%, wage growth slowed to 4.8%, payrolls dropped 32,000. All misses. But markets interpreted it as great. The Bank of England will definitely cut in December now. Probability went from 72% to 86%. Of course, there's also this political drama brewing with Chancellor Reeves potentially announcing 30 to 35 billion pounds in fiscal consolidation. Markets hate that uncertainty, which is why gilts and sterling have been choppy. Liz Truss and the cabbage still haunts the traders.
And Japan? They're always in their own world.
Japan is genuinely fascinating right now. Business sentiment is at its highest since the pandemic, really bullish stuff. But GDP for Q3 is expected to be flat because consumers stopped spending during the heat waves. So you have this contradiction. Businesses optimistic, consumers cautious. The Bank of Japan is trapped between wanting to normalize policy, maybe hike in December, and political pressure not to move too soon. The yen's exchange rate will probably decide it for them.
With the Fed holding firm, what's happening with the dollar?
The dollar has been resilient. As Fed rate cut expectations evaporated, the dollar can strengthen more. That creates all kinds of knock on effects: pressure on emerging market currencies, challenges for commodity exporters, makes dollar denominated debt more expensive to service. It's a tightening of financial conditions globally just through currency moves.
What about the pound? You mentioned chaos earlier.
Sterling's been all over the place. You had weak labor data suggesting rate cuts, but also fiscal uncertainty, suggesting more borrowing and supply of gilts. So you've got rate cut expectations rising, while 10-year gilt yields are also rising. That's not a healthy dynamic. It reflects deep uncertainty about the UK's fiscal trajectory.
Commodities? Anything jump out?
Oil jumped. It spiked Friday on supply fears after Ukraine hit a Russian Black Sea port with drones. That geopolitical premium got priced in quickly. Gold was interesting. Surged Monday when the shutdown ended, then gave back gains as the dollar strengthened and Treasury yields stabilized. It's caught between its safe haven appeal and the headwind of higher real yields. Copper and industrial metals remain under pressure from weak China data.
Speaking of China, their data this week was pretty grim.
It was not good. Industrial production hit its slowest growth since August 2024. New home prices had their steepest monthly decline in a year. The property market continues to be a massive drag, and this is despite all the stimulus measures they've announced. Markets are starting to question whether China's policy response is sufficient to turn things around. But the inflation data turned positive, coming at 0.2% year on year, first positive reading since July. And core inflation continued to rise for the sixth consecutive month, accelerating to 1.2%.
China must be weighing on the broader emerging market picture.
Absolutely. China's weakness in industrial production and property hits commodity demand, which affects exporters across emerging markets. But the bigger issue for EM right now is actually the Fed and the dollar. If US rates stay high and the dollar strengthens, it creates a triple whammy. Capital flows reverse, local currencies weaken, and inflation pressures build from imported goods getting more expensive.
What about India?
India's CPI inflation softened materially to 0.25% year on year in October, well below expectations, driven primarily by food deflation. Core CPI inflation also softened slightly, albeit more moderately. The record low CPI inflation cements the case for a 25 basis point repo rate cut in December. It is simply too hard to ignore.
South Africa? Any updates there?
South Africa had quite a good week, actually. Markets loved the medium term budget announcement. The Treasury revised consolidated revenues upward and cut bond issuance amounts as a result. National Treasury also adopted the new inflation target of 3%. ZAR performed very well, touching below 17 at one point. Finally, S&P upgraded them to BB with a positive outlook. First upgrade since 2005.
That was a long wait. Staying in Africa, Egypt?
Egypt's inflation was a disappointment, proving to be sticky. Rent inflation was a major contributor. That might be one reason for them to stay put in their next meeting. But rate cuts are due to resume in the new year, a hawkish Fed, and a stronger dollar may also keep things in check there for now.
It really does feel like the Fed is driving everyone's bus right now.
That's exactly right. Emerging markets had a window where they thought Fed easing would give them breathing room. Cut their own rates, attract capital, let currencies stabilize. That window is slamming shut. Now they're back in defensive mode, worrying about capital flight and currency weakness. It's a difficult environment for EM policymakers.
Looking ahead, what are you watching next week?
The data flow is key. We should start seeing some delayed reports from the shutdown. If the September employment report hits next Thursday as expected, that'll be fascinating. It's months old, but it's the freshest labor market data we'll have. Any surprises there will move markets, because it's the only thing we'll have to go on before the Fed's December meeting.
Do you think the Fed will actually cut in December?
Right now, it's a coin flip. 49% probability. That's down from 74% just a week ago. If September employment is weak, maybe that probability goes back up. If it's strong, forget about December. The Fed's made it clear they want to see more data, and if they don't have October and November numbers, they'll probably default to holding. The path of least regret for them is caution.
What about internationally? Anything major to watch?
UK budget developments. Chancellor Reeves' fiscal plans could create more volatility. Europe will release more PMI data, which will test whether their recent strength is real or a head fake. And China data will be critical. Is the weakness accelerating or stabilizing? That matters for commodity markets and broader EM sentiment.
And currencies?
Watch the dollar index like a hawk. If the dollar grinds higher, emerging markets will keep struggling. Treasury yields too. If it moves higher, that tightens financial conditions globally, even without the Fed doing anything. Sometimes markets do the Fed's work for them.
Any chance we see this volatility calm down soon?
Not until we get clarity on Fed policy and data flow normalizes. We've had this massive repricing from aggressive easing expectations to almost no cuts that doesn't happen smoothly. Expect more turbulence, more days like Thursday where positioning unwinds quickly. The market's trying to figure out a new equilibrium, and that process is messy. Bitcoin below $95,000, VIX at 20, rotation into defensives. These are all signs of a market in flux.
Sounds like we're in for an interesting few weeks.
When is it not interesting these days? But yes, with delayed data, Fed uncertainty, and year-end positioning starting to matter, buckle up. December could be quite the ride.
Before we sign off, our standard disclaimer, don't forget, folks, we do not give investment advice. For that, please consult a professional. Thanks for tuning in to Economic Insights. We'll see you next week.
Stay alert out there.